Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today. All right, so today we're going to talk about what I like to call a good problem to have. So, having too much capital gains at retirement. I talk a lot about how to sell shares and generate income at retirement, and this question comes a lot for investors that have a big stack of great companies. They've been holding it forever. And now, if they sell those in a non registered asset account, they're going to be hit by a lot of taxes. So yes, it's a good problem to have. It's also a result of a buy and hold strategy, which is usually a good thing, right? You work super hard to find good winners in your portfolio. So once you have one, well, you might as well let it run for several years. But then it could come down to the fact that you've been holding one stock for the past 20 years, and now you're like generating like 1,000% returns or more. So if you sell, there's a lot of it that is going to be capital gain. So that's the problem, right? The problem is, okay, I have like $200,000 on capital gain, on unrealized capital gain on a specific stock. How do I manage to withdraw money from that portfolio without triggering all that taxes? So unfortunately, there is no magic bullet here. You will have to pay taxes at one point or another. Either you will pay the taxes or your estate is going to pay the taxes, but at one point or another, someone will have to pay the tax man. So start with this in mind. Now, the problem is when you have huge capital gains and you depend on that portfolio to withdraw money. So you may be thinking, well, I'm going to postpone that moment or invest in stocks that pays a good dividend and then just live off the dividend. But still, again, you're not really tackling the problem. So the thing that you have to ask yourself is, what's the most important part? Is it to pay taxes or to be overexposed on some of your stocks or some of your sectors? So that would be the first thing, because when you sell stocks to generate income, maybe you can do it to rebalance your portfolio and trim some of your winners to get a better balanced portfolio. I'm saying this because at retirement, it's not the time that you will be able to put more money into the portfolio. It's quite the opposite, right? So you're withdrawing money from your account. So therefore, if the market goes down because there's a crisis, usually the crisis will happen in a specific sector or a specific set of sectors, and then there will be a domino effect. But the biggest sectors, think about the financial crisis of 2008. Of course, banks were in the middle of the crisis, so they took a harder hit than other sectors. Dot-com bubble, same thing. Right now we can think, oh, maybe if we have a AI bubble and it bursts, well, of course semiconductors are going to get hit. A lot of energy stocks, like mostly utilities that are providing power to run those data centers, those cloud centers to run AI, are probably going to take a hit as well. So if you have like 50% of your portfolio in this, then you have to make the difference between, all right, so am I better off not paying taxes but being overexposed, and then what's going to be the impact on my portfolio if I get hit, or what's going to be the impact on my portfolio if I trim and I sell some stocks? So the solution here is obviously starting by having a solid plan. So knowing what will be your income sources in the next 5 to 10 years, so you can see when it will be the right time to trigger maybe a little bit more capital gains than other. Speaking of capital gains and plans, I do have a retirement newsletter, a free retirement newsletter that you can sign up at moosemarkets.com/retirement. You're going to start by downloading a free guide to 20 income focused products for retirees. And then there's going to be a weekly newsletter covering several retirement topics. So moosemarkets.com/retirement. If you are about to retire, or if you're a young retiree, young in the sense that you just retired maybe 2-3 years ago, regardless of the age, we're all young, right? All right. So what else can be done when you have lots of tech capital gains? So the first thing is, of course, try to trim this over several years so you can kind of like smoother the tax rate here. So calculate your expected tax rate every year based on your income, and then you can generate a little bit more capital gains as long as you stay in the same bracket. The second thing that you can do is that you can sell your losers, obviously, to harvest some tax losses. A good trick here, if you really want to be staying invested in those companies nonetheless, is you can sell the stock, buy an ETF that is close to that sector, and then after the right number of days to avoid getting to avoid losing this the tax harvesting loss, you can buy back the stocks and sell the ETF. It's not perfect. The ETF can fluctuate, so you have to navigate through that, but it's either you sell the stock, you wait, I think it's like 60 days, but I can't remember right now. I'm not an accountant. I don't like tax rules. I would call my account for that kind of thing. So it's either 30 or 60 days you have to wait before you buy the stock again. Anyways, long story short, you wait that period, you buy it back. So either you do this or you buy an ETF that is in the same sector. So at least you're exposed to the sector. It's not perfect, but it could work. So tax harvesting, trimming over time, focusing maybe on 1 year, you can decide that you're not going to withdraw money from your RSP and you're going to trigger more capital gains. That could be interesting. And one thing I would suggest here as well is to think about where the money is best invested moving forward. So $10,000 right now in a capital gain in a overweight position, or $7,500 once you pay the taxes at highest marginal tax rate. That will be it. $7,500 into another sector that would rebalance your portfolio. So that is also something you can consider. Of course, no one wants to pay that $2,400 of taxes on that example. But at the same time, you also want to have a diversified portfolio, and you surely don't want to get hit and see your portfolio going down like 40% while it could have gone down maybe by 20 during a major crisis. So those are like small differences at first, but when a crisis hit, it's going to make a whole new world of difference. All right, so that's enough for today. I hope that you will have a great weekend. Once again, if you are about to retire or you just retired like a year or 2 years ago, I suggest that you subscribe to my free newsletter about retirement at moosemarkets.com/retirement. You're going to start with a 20 income focused product guide, and then we're going to talk about retirement. If you have any other questions about it, this is the right place to be. So you can send me emails, ask me questions, and it's going to give me some inspiration for new topics. We're going to come back on Monday. And until then, don't forget to stay invested.